I see it all the time. Interest rates that seem too good to be true, and I want to help you avoid getting duped. Rates are one of the biggest factors that determine how high your monthly payment is and how much you'll pay for your home over time. But there are a lot of hidden fees that can be misleading. I'm going to help you identify the biggest red flags you need to watch for when it comes to mortgage interest rates so you don't end up paying more than you should. In case you're new here, I'm Hannah, a real estate agent serving the Carolinas and working alongside my three sisters. We've helped over 1,000 buyers and sellers make smart real estate moves, and I'm going to help you do the same. Buying a home is a big financial decision, so we made a free home buying guidebook to walk you through everything you need to know to start the home buying process. You can grab your free copy using the link below. Now let's talk about the biggest interest rate red flags and how to avoid them. First one, advertised interest rates are often misleading. You've probably Googled rates and seen one or two lenders advertise a rate that's way lower than the rest. Here's the truth. Those rates usually assume you're paying for discount points up front to lower your rate. A discount point is a fee you pay at closing to reduce your interest rate, and while it can make sense in some cases, it's not always the best option, and definitely not free. Here's the catch. If you don't plan to stay in your home long enough to break even on those upfront costs, you could actually end up losing money instead of saving it. Before you get excited about a low rate, make sure you understand what's actually included in that number and whether buying points even make sense for your situation. Know how to read a lender worksheet. Not all loan estimates are created equal, and lenders often structure their offers and fees differently. That's why it's critical to know how to break down a lender worksheet and look at more than just the interest rate. Here's what you need to focus on: funding fees. Some loans, like FHA or VA, have upfront fees that add to your costs. You want to be sure you're factoring those in when comparing loan options. I'll go into more depth on this later. Discount points. We just talked about this. Some lenders may quote a lower rate, but that's only because they're assuming you're paying extra fees to buy down the rate. Estimated taxes and insurance. Make sure these are included so you get a clear picture of your total monthly payment, so you can compare the cost of one property versus another. A lender who estimates these too low can make a loan seem more affordable than it actually is. It's important to note that property taxes and insurance costs will vary from one home to another, so it's crucial to use a great lender who will run estimated monthly payments for specific properties, so you can compare apples to apples. Another thing to note is that some lenders will include monthly HOA fees too, even though these are paid separately, not as a part of your mortgage payment. Just another way to compare costs between homes. When comparing lenders, don't just click on the lowest rate. Make sure you're looking at the full financial picture. If you need help finding a great lender who will walk you through all of this, I have personal connections with some of the best lenders across the US that I can connect you with. Just click the Get Referred link below. 3. Understanding the difference between loan types. Different types of loans come with different interest rates and fees, so you want to understand the differences. Here's a quick breakdown. FHA loans typically offer lower interest rates but come with higher mortgage insurance premiums, often referred to as MIP, that last for the life of the loan. This means even though your rate looks better, you could be paying more in the long run. Conventional loans usually have slightly higher rates than FHA, but they don't require mortgage insurance if you put down at least 20%. And even if you put down less than 20%, you don't have to pay mortgage insurance forever. Typically, it'll automatically drop off when your principal loan balance reaches 78% of the original home value, or you can request cancellation when it reaches 80%. This one difference can save you as much as $100 or $200 per month and thousands over the life of the loan. VA loans. If you're eligible, these are fantastic because they offer competitive rates with no mortgage insurance and no down payment. However, they do come with a funding fee, so it's important to understand how that impacts your costs. But typically, these are great loans and a wonderful way to thank our veterans for their service to our country. When searching for a lender, avoid these 3 interest rate red flags by understanding the different loan types, knowing how to read a lender worksheet, and not falling for misleading rates. Buying a home is often your largest financial investment, and a make or break in building wealth. So I want you to feel confident in your decision. Be sure to check out this video on how to buy a house even if you have bad credit, and download your free copy of our home buying guidebook for even more insider knowledge on the process.